We're really going to talk about check-in state of affairs with multifamily and where we've come from over the last 2.5 years has been a bit of a wild ride, and where we are now and where we think we might going. And the thesis is now actually a good time to get started in multifamily investing, or did we already miss it, or should we wait a little bit longer? And what we're going to do here is we're going to talk through that a little bit. And the thesis really is that the thing that has changed more than anything else is that the risk has changed over, say, 2.5 years ago. And so we're going to talk about what is this thing called a risk-adjusted return, and why should investors care? If you're a passive investor, why should you care? If you're an active investor who want to get into multifamily, why should you care about risk-adjusted return? And just in general here, the risk-adjusted return means that there's a thing called return, which is pretty straightforward. It's like, well, what is the average annual return? What's the IRR? What's the cash and cash return? The thing that is less understood and people really don't pay enough attention to, which is why I'm shining a light on it, is the risk. In other words, I can make my spreadsheet say anything I want. I can put a 20% average annual return there, right? And a lot of operators do. I've seen a lot of different marketing packages go around with fantastic returns. But the question is, what are the underlying assumptions in those returns? In other words, how are you getting to those numbers? What assumptions are you making? Are you making more aggressive assumptions? Are you, for example, projecting very aggressive rent growth or occupancy or any kind of other assumptions? And what we want to talk about here is, if you're a sophisticated investor, asking questions around those assumptions. Don't just look at the returns and look at one marketing package and another marketing package and go, oh, the returns are the same, or this one's returns higher, therefore I'll go with that. It's all about what are the underlying risks involved. And you and your portfolio have to look and see, where am I investing? And you have specific goals in your investing, right? Sometimes you're investing for safety, so you might put money in your money market. Sometimes you want something a little more exciting, so you invest in crypto. How exciting is that, right? And there's stuff in the middle. You have some equities in there, some stocks and bonds, maybe a portfolio, but then you're investing for tax advantages. So maybe you're getting more involved in oil and gas for getting the tax advantages, which is also a little speculative. And then you might get into real estate because you're getting a mix of both. You're getting some cash flow, you're getting some above average returns, and then you're getting tax benefits, right? And so you're getting all these things where you're trying to achieve different things in your portfolio, but then you also have a risk spectrum as well. So today we really want to talk about the risk spectrum here as well. And to help us with that is our co-host, Garrett Lynch. Garrett, what's going on?
What's going on, Michael?
Yeah, so I want to talk about what has kind of transpired here in the last 2.5 years, and why the risk-adjusted returns are vastly different today than they were 2.5 years ago. We're going to stay in the multifamily space for now, right? Even though I talked about the risk-adjusted return in general, like I said,
Hmm.
but with the multifamily space, multifamily has been historically on the lower end of the risk spectrum from anything you could do. And the reason that we know that is because the kind of loans we get are the cheapest you can get, the highest leverage you can get, the longest amortization you can get, and a lot of it is interest only, and most of it is non-recourse. It's really kind of wild. If you talk to mobile home park investors, for example, it's not like that. The interest rate is higher, the leverage is lower, things of that nature. So this is why institutional lenders appear to think that multifamily historically has been one of the lowest risk investment, which is really cool. So that's in all of the spectrum of what you could do, it tends to be on the lower end of the spectrum. Now, within that lower end of the spectrum, though, the risk-adjusted return has changed dramatically. And I want to talk about that, Garrett. I want to talk about what really has changed so dramatically over the last 2.5 years. I feel like what we've gone through in the last 2.5 years is typically something that takes 7 to 10 years, like these slow market swings we had like in 2 years, 2.5 years.
Hmm.
And one of the things that really have changed is the interest rates. The interest rates obviously are higher, but also the outlook for moving forward is higher. So now let's rewind the clock a little bit. Where were we 2.5 years ago? Where were the interest rates? What was the outlook? And why is that matter when you're looking at the risk-adjusted return?
Yeah. So when we first got into the craziness of COVID, so what you had was kind of a black swan event that's really helped multifamily. In the beginning, everyone was kind of scared and they froze and they're like, "Oh, we don't know what to do right now with all that's going on." But what happened is interest rates went down to the lowest level we'd seen in a very long time, really like historic lows. And so that made the multifamily investment vehicle look really strong because now you're able to get all this money from banks for essentially nothing. And so prices started to rise. Not only that, there was the inflation hit from all the stimulus checks. So you're having all this new money hit the market. Now rents are going up. So you have a combination of rents going up and then interest rates dropping. And so that just made everybody go frenzy after multifamily. And so what a lot of people were doing where they were going in, buying it, finding a deal, a value add deal, and they were getting a loan from the bank with very high leverage, like 80% or more. And then they were getting not only that construction loan on top of that from the same bank. So they could do all their construction through the bank and get a high leverage. Then you only had to raise a small amount of money, you can get it in a huge deal. So a lot of people were doing that. And then there was that obviously juices your returns, your projections, and everything. You can underwrite $500 rent bumps. You can underwrite really low interest rates, and it didn't matter how conservative you were being. You weren't prepared for what was about to come, which was the downswing effect. So then you had interest rates. Well, after all this COVID stimulus, all that stuff. Yeah.
Before you get to that, okay, before we get
Yep.
to what happened afterwards, so one observation I want to make is that historically interest rates were at an historic low. Everybody agreed on that. Oh, people also did agree that interest rates would go up eventually. Now, no one could foretell what would happen, but in general, historical low interest rates, the only direction it could go was up. So I just want to observe that because that's where we were 2.5 years ago. Now, talk about what then happened.
Yeah. So interest, we were assuming that everyone was really assuming that interest rates are going to go up for sure.
Which is bearish, obviously, right? Because
Yeah.
if interest rates go up, then therefore cap rates would go up and prices would go down. And we actually we incorporated into our underwriting. We already knew interest rates would go up, and that wasn't the problem in itself.
Right. So you were doing your normal stuff, your underwriting. I think the hardest thing to predict is maybe the exit cap rate when it comes to these deals, and you're underwriting 100 basis points or more over where the cap rates were, just to be conservative, along with interest rates hiking and going up over time. The challenge that happened is that interest rates went up so quickly, so high. And so you had, even beyond what anyone would underwrite at that time, any economist would think of, you had things fly up. No one saw it going that fast up as high as it did. And so you went up like basically 5 points in a matter of 18 months. And so pricing just came down across the market. Banks froze up. They're offering now low leverage. Now you've got people that did these short-term loans that were variable rate loans in a position where they can't necessarily refi out of them in time because values have dropped. So a lot of things happening. Banks are, freaking out. But a lot of what happened during this time frame is there was no indication that things were going to swing so heavy in one direction, except for maybe inflation if you're looking at that as an offset. But the narrative is that everyone was saying is, well, you can't raise interest rates that high or it'll crash the market. So you can't, right? So, but they did anyways. Didn't end up crashing the market. They're trying to soft land it, but there was a lot of implications from them doing that, the Fed. So now you're in a position where you got all these short-term loans that you're getting financing on the construction from the bank. You're getting high leverage on them, and you can't get out of them because values have dropped. That exists. So that was kind of what people didn't see. The variable rate aspect to the loans that were happening, because that was what you did because you knew you could get out and not hit a prepayment penalty. And then you also were being competitive with other people in the market that were doing the same thing. So now you got all these things happening, and the bank's tightening up, lowering leverage, interest rates are high, all these things have shifted. So if you're doing any deals, all those deals then are getting all beat up. You got investors that are scared, all these things happening in those 2 years. And there's a completely new landscape now, which is much different than what we just saw then, because we can kind of see a little more clear about what just happened. We had this huge run up in pricing and a big drop in pricing. And now we kind of have a better visual as to what that might look like, at least if interest rates even stay flat. But
Before
Yes.
we get to that, just to summarize a little bit. So 2.5 years ago, we were in a historically low interest rate environment where the general outlook projection for interest rates was up in general. Okay. So that obviously puts it on a more bearish outlook because interest rates are going to go up. It would obviously affect prices and things of that nature. Also, at the time, leverage was at an historic high. I think, Garrett, what you mentioned is that we would get not only 80% of the purchase price, but 80% of the construction. So it's very high leverage. It's almost inconceivable how we get even higher leverage. So in the spectrum of how much leverage you can get, that was probably at a historic high as well. You also talked about prices. All this effect of low interest rates and high leverage resulted in higher prices. And that is because people are always looking to get about the same return. And if you are going to get a higher return because your cost of capital is lower or your leverage is higher, I can pay more. And so the combination of that drove the prices up. The height of the market was in March in 22. And that was where we were in March of 22. And so if you look at it, and we sensed it, everybody sensed it. We're like, man, historically, we are at the kind of the height of the market. I think collectively we're thinking we could probably coast here for a little while longer, which probably we could have. But just to summarize, we were on the height of the market 2.5 years ago. And and now what has happened, what you're saying is interest rates went up rapidly, so the cost of capital went up. And then lenders reacted with much lower leverage. What do we get like 9 months ago? What are we getting now? What happened there? How did the lenders react? And kind of what are we seeing now?
Yeah, so lenders tightened up and they said you had a lot of local banks, like regional banks, just stopped lending altogether in multifamily. You had the agencies pulled back and they're only allowing a certain amount of leverage. So they went to 65% leverage. They're back up to like 75% now. But for a
But only
period
the
of time,
purchase price. Are we getting construction loans?
no, there's no construction loans. So you're not getting any construction dollars on top of it. So now you have to come with more equity into the deal. But the positive of that is that it makes it safer. So you're now going into a loan. Think about, why does it matter if you have high or low leverage? Well, if you have a lower loan amount, you don't have to pay as much on an ongoing basis, especially if you have, interest only or whatever. But even if you don't, you can afford the mortgage payments. So your break even occupancy can be at a much lower level. Plus, you're not adding in construction dollars from a bridge lender. And on top of it, you have a longer time frame where you can sit in the deal. So you can get a loan that's 5, 7, 10 years, and you know exactly what you're going to pay for your mortgage the entire time. It's fixed, so it doesn't fluctuate. And you got lower leverage. And so the capital stack is really important when it comes to these multifamily deals and structuring them the right way. And you really have two options. You're either going variable rate or you're going fixed rate. And the fixed rate is always going to be safer. But because of the way the market was before, nobody wanted to hit those prepayment penalties. They were just going with variable rates because it made sense because you could exit for nothing. So, and there were people exiting like crazy, making a ton of money and not having to hit those prepayment penalties. So it was, it's a completely different investment now. Honestly, it's the same fundamentals are there. You've got people that there's still demand to live in apartments, but you have a different capital stack that's going in a different structure in general that makes these things even safer. And so it's hard for people to understand that are not in the business, I think, or that are not super familiar with how these things work, which is why we wanted to talk about that today.
Yeah, this is exactly right. I mean, a lot of people that aren't paying attention, they just see what's in the news, or maybe they know someone who's been affected by it, but they don't really dig deeper. And our goal really is to educate our investors because we consider our investors sophisticated, the kind of investors who dig a little deeper, and that's what we're trying to do here today. And what I heard you say is several things that are different right now. One is, well, the interest rates are higher, obviously, and I wouldn't say they're at a historic high. They're certainly at a high over the recent one. But the most important thing that the general outlook is flat to down, which is vastly different than 2.5 years ago when the outlook was flat to, well, was up. It wasn't even flat; it was up. Now it's flat to down. People argue, but general, no one's really saying interest rates are going up, which is different, totally different. And the other thing is the leverage. You're talking about our leverage is much, much lower than it was 2.5 years ago. And so the result of all these things makes the prices, of course, affects the prices. And so as a result of that, because interest rates are flat to down, the other thing that's going to happen is because of the relative stability in interest rates. It's not that it has to go down, but if interest rates simply stay where they are, it provides stability, which means that we're already seeing it now. You mentioned it. Lenders are already increasing the leverage. Now, of course, it's still at the high interest rate, but what I'm point is they are now associating this environment of stability with less risk and uncertainty. Therefore, they're increasing their leverage, and we're already starting to see that now. And if you look at the kind of prognosis for prices and cap rates, I have this chart here. Found this on Statista. Statista always has a bunch of really good stats on there. You know, the green line is kind of where we are right now. You see kind of the cap rates plateauing out, and the prognosis is down for the reasons we just talked about. The prognosis of cap rates is going down because the cost of capital is projected to go down, but also related to that, leverage will slowly increase even if interest rates don't go down. And so because of that, prices will go up. And if you just look at this bar graph here, you can see kind of in 21 or the 22, the market was a high, just jumped straight up. By the end of 23, it was super high. And we just swung from this, like in 2 years, went from one market cycle to another. And it appears now that we're at the bottom of the market, which is why we want to talk about that. There's still a lot of fear and uncertainty out there, but us looking at what's happening right now, we think it's probably the best time to buy multifamily in recent history. It reminds me a little of 2008, Garrett.
Yeah, you had other things happening also during this time frame, which I didn't mention, but you had rents that were at historic highs, coming back the other direction because of oversupply. So during COVID, you had a lot of new starts and new developments, and all those starts were being delivered now, around now, last year, this year. So you have this oversupply issue in a lot of the major metros, and so your rents that you were getting $500, $600 rent bumps are coming down to like 100, 200, right? But this is a temporary issue. So not only that, inflation caused insurance to go up, plus just the market insurance to go up. There's taxes that are always going up. Your overall cost to run these things are going up. So you're getting hit in a lot of ways, and these are all really. It's a good time to get into a deal because all these things are doing is dropping pricing. And as we know in market cycles, prices go up and down, and you want to buy low and sell high, right? So you're trading now. You have to pay the bank more money is in the form of interest rates. So you're paying them, 6% when maybe it was 3% before. But the trade-off is that with all these environmental issues around everything that's happening just in the market, you're getting price reduction of a significant amount, 30 to 50% or more, from peak of market pricing, which was March of 2022. So now you're in this much better situation. You have a lower basis on deals that you find right now. They have to make sense. They obviously have to pencil. You have to be conservative with your assumptions and your exit and just ongoing. But you're doing that because now I'm only going to project the rent bump maybe a 50, $100 versus $500. Organic rent growth is going to be flat. My leverage is low. My cash injection into the property is heavy. And as long as I assume my exit cap is going to be something reasonable, it's a very strong chance you're going to win on these deals if you go and operate the property and do it right. And so that's where we're at now. And
Yeah.
deals are difficult to come by for sure still. But if you find one that makes sense and pencils and you get into it now, there's a much higher likelihood you're going to win, I think.